We do the asset management. We're very actively involved with these assets. We also have a huge team. We have 160 plus people here locally. We don't have any virtual or part-time, non-local employees. Everyone's full-time. Everyone's working either at the sites or working at the corporate office here in Uptown. So we have about 40 people uptown here, and then another 125 or so at the 22 sites. And we just do multifamily. We don't do self-storage. We don't do data centers or industrials or shopping malls or shopping centers. We are literally, like, what I like to say is an inch wide and a mile deep, meaning we are specialists in this one thing. We do it extremely well. And, you know, in 2024, it's much more advantageous to be a specialist than a generalist. So we are very, very good at this one thing, and we know what we're good at, and we stick to it. There's a lot of shiny objects out there and a lot of interesting investment opportunities, but we have our 10,000 hours in multifamily, buying cash flowing real estate, giving depreciation to investors. We have a track record. We've exited around 6 deals, returned about 60 million to investors, close to a 30% return. So it's myself and Alok who are kind of the main guys over here, but then we've got a large team behind us that focuses on asset management, operations, construction.
I'm going to show you guys the team. So yeah, it's not like, you know, you might work with some groups and it's just like a small kind of bootstrap team, but this is a solid team, if you can see on the screen. Cool. All right, so I didn't mean to kind of jump in right when we were talking.
No, I think it's perfect transition because that's our track record, and that's how we sort of, you know, blend these two puzzle pieces of Sugo and Ashland together. And then obviously, you know, Sarah has extensive experience and a great track record as well. So Sarah, I'd love to have you talk about that briefly for those that are new, maybe.
Yeah, thank you. So this is our portfolio, and you can see that there's a lot of green in the center, and it's hard to get all those flags exactly where they are, but the majority bulk of our portfolio is in Dallas. And right now it's a little over a third is in partnership with Ashland Green. And so the flags that have a yellow bar, those are those ones that we've exited and we don't own anymore. And the solid green are those that we still own. And so the breadth of partners that I have worked with and the breadth of markets has been really fun. And I've elected in 23, 24, and likely in 25 to work primarily with Ashland Green in the Dallas market. Like Shakti said, they're specialists in this area. And I've tried. I was like, guys, what about this market over here? Guys, what about storage units? Like, it's, you know, that's shiny object. And they're like, look, Sarah, maybe in 26, but for now, in 24 and 25, like this is our specialty. We're experts here, and there's a lot of opportunities coming up. So we got together with the co-GPs and partners. It was 2 weeks ago now, and we really talked about what's going on in the market and what's the future. We're going to hit on that just a little bit today. But this is Sugo Capital, and then Ashland Green. A lot of you have probably also spoken to Alok, and his team, the team under him, Zyra, Investor Relations. So if you guys enter this deal, or those of you who have already worked with Sugo Capital and Ashland Green co-GP projects, you'll have probably talked to them or received emails from them or seen them on the investor webinars before. I did skip over the disclaimer. I'm going to go back to it just because it is always important to have on record, and we're recording. You know, we want to always point out that you need to do thorough due diligence, and that there is the possibility of loss of capital with any investment, and no returns are guaranteed. So we're going to talk about returns for this project and the preferred returns and the waterfall, and those are all targets. And know that whoever you're speaking to about investments, that all investments have the inherent risk of complete capital loss. That's our disclaimer. Anything else you want to say on the disclaimer, Shakti?
No, just that, you know, Sarah and I, we are not CPAs or attorneys as well. So, you know, we'll give you guys information to our best of our abilities, but if you need to consult with your professional team, then obviously do that before you make the investment.
Definitely. Thanks for that. All right, so there's the team. Do you want to go into the mission and the 4 T's as well?
So I mean, it's pretty simple. We serve basically, you know, 3 main constituencies, which is our investors, you guys, our employees, and our residents. And we feel if we serve these constituencies correctly, we can serve the broader communities where we own and operate and make a positive social impact. And then here's an acronym that we have plastered on our wall in like 6,000 point font when you walk in.
Yep, yep. It's there in the office.
There, yeah. So it's just respect, accountability, integrity, service, and excellence. And we just like to say that we raise the bar for ourselves and each other. So we're definitely a culture that strives to continue to get better. And you know, as we encounter challenges, we certainly we keep pushing in everything that we do, but we do it within a realm of reasonableness with integrity, respect, and accountability. So it's very important when you're partnering with a company or investing with a company, you want to know what they stand for, and this is something that's kind of at the forefront of all of our internal discussions with our investors, et cetera.
Yeah, it really shines through, guys, in the we've been working together for over 2 years now, and it is really true. All of that shines through. Everyone says, transparency, respect, etc. But they're actually living it. It's the difference.
Thanks, Sarah. So yeah, we just have basically, 3 for-profit companies underneath the Ashland Green umbrella, and then 1 nonprofit company. And so the 3 for-profit companies are Ashland Green Capital, right? And can you hear my
Yep, you sound fine.
Okay, I just want to make sure. So yeah, Ashland Green Capital is acquisitions, dispositions, investor relations, asset management. And then AG Living is our property management company. So it's a separate company, and basically it serves Ashland Green Capital. So Ashland Green Capital is where all our asset managers sit, and AG Living is where our property management company sits, and their only client is Ashland Green Capital. Whereas if sometimes you work with third party, you have a property management company that has 40 or 50 or 100 different clients, and each client has a different requirement. We're very standardized in our process. It gives us a lot of control. The fact that AG Living is vertical and belongs to Ashland Green parent company, and that it only serves 1 client, which is Ashland Green Capital. And then there's, of course, Ashland Green Construction. All that we do here is value add rehabs. We don't build anything from the ground up. So our own construction team handles the construction management. One of the unique things that we do is an occupied interior renovation. We've done over 2,500 units occupied over the last 2.5 years. It's really hard to perfect that, but we've sort of cracked the code, and we've been able to do that by not outsourcing to a GC. We actually buy our own supplies at a deeply discounted rate, and we're able to also pair our supplies with our labor partner. And so our labor partner is not responsible for getting supplies. Supplies isn't responsible for bringing the labor. We split that up, and we pass those savings through to our investors. So we're able to do units up to 3 to 4 units per day. And we're able to reduce the cost of those renovations anywhere from $2,000 to $3,000 per unit, which flows right back to the investors. And then last but certainly not least is Ashland Green Impact. It's our corporate philanthropy arm. It's our 501c3. My wife is actually out at one of our properties called Ronan today. It's Breast Cancer Awareness Month. So she's got the mobile mammogram over there, and she's partnering with Moncrief Hospital. I can share some pictures if you want to see anything, Sarah. I don't know if we have time, but
maybe at the end once we get through everything.
okay.
Yeah.
She's out there today, and she's doing programming once a month at the various communities. And we kind of focus our attention around 3 main pillars with impact. It's health and wellness, education, and employment. And those are all things that were very important to my wife and I as we were growing up and being raised by our parents. So we like to get our investors involved when we can. We certainly get our employees involved and our residents involved, and it's open to not just the residents that live in our community, but it's open to all residents of the area. So if it's in Arlington, everyone in Arlington's invited. So we have about depending on the event, we can get anywhere from a 30% adoption rate to even 80 to 90% when we do our backpack drives. All the kids come in and participate in that. So it's high efficacy. It's actually one of the things we're really proud of that we do on a regular basis. And there's some benefits also with our loans as we work with Freddie Mac and the agencies on their affordable mandate to try to get preferential pricing. So that's something we're working on in the background, but it's one of those things that just feels good and it feels like it's the right thing to do.
And it contributes to the longevity of the community at each of these properties. So it's not like a high rise that's kind of this cold feeling. All of the Ashland Green properties and most of the Segal Capital properties as well are that garden style where community is really important. A lot of the CapEx project is around creating really nice community amenities so that the stronger bond you have with your neighbors, you end up staying. So I think especially Zocalo, it already has that 4-year average tenure, and so incorporating more of that impact, those events into different properties will also increase the tenure of tenants at those properties. It's a win-win for sure. All right, just looking at time, so I encourage everyone to go through as part of your due diligence, those who are new to Ashland Green, and really look at the details in there. So there's a lot of great detail. This is really important, so I would like you to touch on this too, Shakti.
Yeah, so this is something that you guys need to look at from an investor's perspective. It's called the 4Ts. Basically, we came up with it last year, actually on a webinar. It was sort of impromptu when we came up with it, because I was on the webinar talking about the 4Ts of a landlord. It was termites, toilets, trash, and tenants. And then someone on the webinar said, what about the 4Ts for limited partners? And I said, well, what would those be? And on the spot, he just said, trust, track record, team, and transparency. And we're like, hold that thought, let's write it down. And it's really perfect, because when you guys are thinking about either being a GP or an LP, you make a decision. Do we want to deal with trash and tenants and toilets and termites? Or do we want to invest with someone that does that, like Ashland Green? And what do we look for if we're investing with someone that's dealing with that as a landlord? So you look for trust, track record, team, and transparency. So trust is, can you trust the sponsor? What do they stand for? What is their mission? How have they conducted themselves? What is their reputation in the community, et cetera? Track record obviously speaks for itself. It's just about historical performance and have we achieved the returns that we promised. And then the team, obviously, it's not just one person. It's not just Sarah and myself that, manage these deals on a day-to-day basis. It's a large team of people that are executing on these. And what is the team? How long have they been in this business? How is this team managing risk? And then, of course, a huge part of investing with a group like ours is, what does the reporting look like? What does transparency mean? Because that means different things to different people, right? I'm a very direct person. You can pretty much ask me anything and I'll tell you. But one of the things that we try to do on a quarterly basis, of course, we send monthly financials like everyone else, but we like to get up on a quarterly basis in front of our investors and do kind of an earnings call. It's just kind of a state of the union with the portfolio. How have we progressed over the quarter? And then what you'll see from our investor relations team is really good responsiveness, really fast. You're not going to wait a week for a response. We'll get back to you quickly, tell you that we're working on it, and turn it around, turn the request around pretty quickly. So it's nice to know when you park your money with us, you're not just going to see us one time at the beginning and one time at the end. You're going to see us every quarter and along the way as well. And we know that, that's a big part of the decision is, we're going to be together for 5 years, if not longer. And we don't just see you guys 2 times at the beginning and the end. We see you the entire way.
Yeah, it's awesome. I love their investor relations team. You guys will too. All right. So these are all your properties, right?
Yeah, so these are all properties. The red ones have exited. The star is, there's 2 stars. There's a yellow star, which is Ashland Green headquarters. And you can see we're just about, maybe 4 or 5 miles from Villas del Zocalo, which is the other star. But all our assets are in DFW. We are experts here. We've purchased over 7,000 apartments. We've sold over 1,200. We're about at 6,000 right now. So certainly experts, one of the largest owners in DFW currently.
Yeah, it's awesome. So you guys, when we talk later about the pro forma, and lots of people are like, well, how'd you come up with, you know, how much you could raise rent or what insurance will be or what taxes will be. It's like they're not guessing what the market's doing. They know what the market's doing. They have all these properties and all the different submarkets. So they really are experts on the area. All right, so I encourage you again to go through and take a look in detail. These are all the properties. They list their exits. And now we'll go ahead and jump in to the executive summary and talk about the property. Now, I think it's really cool. You can see how colorful the property is. And totally on accident when we went, I had on a blue shirt, a red skirt, and yellow shoes. And I was like, oh, I'm totally like getting the vibe of this place. I love it. So we're going to do a survey for the tenants to say, do you like it? Should we keep it exactly as is, or should we have some different color schemes? Because lots of times when Shakti's team comes in to a property, you know, there's a remodel, there's a facelift, there's a different look and feel. And so I think it'll be interesting to see from the tenants if they vote for a new look and feel, or if they like to keep this feel. All right. Oh, I thought I put this later. All right, well, I'm going to start with this. So I mentioned that I went out a couple weeks ago, and it was really timely because, you know, all of us are experiencing different, we have properties that we've invested in different markets over the last 5 years, right, as an LP. And so there's a lot of people who are in a state of kind of like, I don't want to say fear, but I guess tentative about jumping back into syndications because they've been seeing that they're not as lucrative as they used to be. And so while we were there, we went and visited commercial lenders, commercial brokers, Marcus and Millichap, and the message was really clear from everyone. It was that now is the time. So now is the time in Dallas, and now is the time in the market cycles. So I'll start with the top left. So we went to visit Marcus and Millichap, and they said, so you can see my quote, I said, who's left out or who will be left out? And so they were saying, man, the people who got burned from their properties that they bought in 2022, and now they're too afraid to jump in, those are the folks who are really going to be left out. And those who jump in now, within the next 12 months, this market cycle, the buyer cycle, the next 12 months is like going to be like it used to be, like the heyday when things were fantastic. And so that's Marcus and Millichap, commercial brokers. And then we also went to visit Northmark, and they were talking about how they are seeing a large influx of international investors coming to the Dallas area, both for debt and equity. And so that's really telling when the rest of the world wants to invest their money in a certain area. And so I was like, oh man, we gotta pick up the properties. We've got to get in there before all the international investors come in there. And it wasn't just all anecdotal. You can see there's rent growth pickup and #1 state for corporate relocations. These are data points and metrics that we were looking at with the commercial lenders and brokers to really have a good understanding of the market, where it's going, and the timing. And so you've seen 2 properties from us this year. This will be our 3rd and last property this year, but we expect in 2025 that there's going to be a lot more on the table as far as juicy deals like this one. And then you can see the lower left corner. Shakti really went through different market cycles with us, and I thought it was really interesting the way he presented it, because if you look at commercial real estate and the market cycles, like when to buy, when to sell, and the ebbs and flows, it used to be kind of this long, it might be like a 12-year, and then it kind of started getting skinnier and skinnier. And he's been looking at some data, and he pointed out that he thinks that the next buy cycle, we're just getting into it, and then it might only be like 9 or 12 months. So instead of like, oh, it's going to be a good time to buy for the next few years, it might be quite short before it moves from the buyer's market into a seller's market. And so that was also something we talked about as a team, like how do we prepare for acquisitions and dispositions depending on where we are in this market cycle. So I'm going to include in the data room some more information about this, so you guys can do some more research on if now is a good time to enter real estate, because that's, you know, market cycles is super important when deciding when to invest. Anything you want to say about that, Shakti?
Well, I love this slide. I didn't see you sneaking in all these pictures.
Yep. Surprise.
Um, Yeah, I think you summed it up pretty well. So
Okay.
there's just a huge opportunity, guys, in front of us. We started. I bought my first deal in 2010. Um, I was in finance in New York in 2008, and the firm that I was with was called Lehman Brothers, and went out of business. And I decided to get into real estate because I kind of saw the writing on the wall, like this is the time to move. And had I not moved in 2010, I probably wouldn't be here in front of you presenting because I wouldn't have had the money to go, be the, I'm the largest investor in all of Ashland, in all the deals in Ashland Green. We don't just bring these deals to you and have you guys invest and then we make a fee or we get a promote at the end. Like I'm actually the largest investor in Ashland Green. Sarah's also a very large investor. So we believe in the deals
Mhm.
and I'm going to be going in larger than I ever have over the next 12 months because real estate, it is about location, 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 but it's also about timing, 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 and it's
Timing.
also about capital structure, capital structure, capital structure. So if you can get the location right, you can get the timing right, which is the most important thing, and then you can get the capital structure, meaning how you're putting your debt and equity on the deal. Um, those are the three ways to make money in real estate. And now the timing is there. You just have to make sure you buy the right location, partner with the right operator, and put the right capital structure in place. And you guys will see here in a minute the numbers on this deal are out they're insane where it's completely conservatively modeled.
Yep.
But this could be like a 2.5 to 3x kind of deal. We're not going to show you those returns today. But I truly believe that we have some conservatism built into our model
Yep.
and our exit cap rates. We're exiting at a 6.75 exit cap rate. And we're entering at a 6.6 cap rate. We've got 4.95% fixed rate debt with 2 years of IO already locked in with Freddie Mac. So you just look at that, you're buying at a 6.6 cap rate and you're borrowing at a 4.95, and we haven't even touched the rents. So when we go in there, the comps next door are getting $460 rent increases on some of their units. We're modeling much less, being way more conservative. I think more in the range of 150 to $250 for our rent increases. But once we start going in there and raising rents, doing our renovation, we're going to take this deal from a 6.6 cap rate to a 9% cap rate. But the whole time we'll still be borrowing at 4.95%. So this thing's going to be a cash machine. And there's very, very little in this deal that concerns me, or there's nothing in the profile of the deal that tells me that there's unmitigated risk here. Like all the risks in terms of the timing, the
Yeah.
capital structure, the business plan, and the location, to be honest. I mean, within a couple of miles, you're in Highland Park, you're in University Park, you're in Bluffview, you're in Preston Hollow. Those are the wealthiest neighborhoods in Texas, let alone Dallas. I mean, this is all of Texas. And so there's this tiny little pocket next to the airport here at Love Field, and it's called Bachman Lake. And you have $1 million homes next to older apartments, and it's only a matter of time before this demographic or before this area completely gets changed for the better and gentrified. So we're kind of coming in early, buying this at an extremely low basis, 75,000 a door. I mean, for those of you that have looked at deals across the Sun Belt, looked at 80s deals, if you've never looked at a deal, $75,000 is very cheap. I mean, we had deals in our portfolio that were great deals at the time at 125,000 per door.
Yeah.
And 80s deals at the peak, guys, in 2022 were selling for 160 to 170 per door. So you talk about being below replacement costs. You couldn't build this deal again today for less than 170,000 per unit. And so we're buying this at a fraction of replacement costs, below what the comps are. So there's just a there's just there's too many things in here where you have so much buffer. Your median income is strong at 45,000. You get a lot of roommates over here. High percentage of one bedrooms, about 82%. We're taking the rents from $963 to $1,197. So not a really huge rent increase, but we're still putting in 10 to 15,000 per unit. So we have about $15 million of value that we can add to the property. And we're buying it for 14.5 million, which is about $136 a foot. We're putting about $5 million of CapEx into it. taking a senior loan from Freddie Mac at 10.8 million and raising the balance of the equity on the webinar tonight. I floated this deal, Sarah, just by some of my, larger investors that have been in all of our Ashland deals. And, these are quick phone calls, 20 to 30-minute check-ins that I do on a quarterly basis with some of our larger, more active investors. And pretty much every single one of them told me they don't really respond to my, like the big email blasts. You got to call these guys and they put in 250, 500, a million. And every single one of them was like, what? These numbers are, they're, this is crazy. And this is a deal that we made, guys, like a couple months ago before the Fed cut rates. And I'm sure the seller would, I mean, he's a friend of mine and he wouldn't do this, but I'm sure that if he canceled our contract, he could probably take it out to the market and get 16.5 to 17 right now for it.
Yeah, I think, giving a little more background as well on this property, because we say a lot in this slide and then in other slides around comps. And we say, phase 3, phase 1, phase 2. So the seller, since you just mentioned him, he built 4 apartment complexes, right? So they're similar vintage, same developer, same owner for a long period of time. And so when you see like that first one, the Dahlia sold for 87 a unit, and that was Villas phase 1. So there's phase 1, 2, 3, and 4. So this is phase 2. So it's one of the, it's phase, so they weren't all the same exact year, but similar vintage. And so it's not like a random comp. It's like a very, very side-by-side twin sister kind of comp. And so that's super telling. So when you see, oh, it's 13,000 per unit less, it's on Villas, it's on versus phase 1 and phase 2. So and the rent bumps, you can see in number 3, achieving 460 average rent for upgraded units. That was phase 3, where we are buying phase 2. So there's really strong evidence that we're getting a great deal, and that our business plan is already proven with the other properties that are the same vintage, same owner, same developer. So that's super cool.
Yeah, and those properties, the owners are pouring millions of dollars. We drove around and we looked at Milo. We rented like a small Sprinter van, and it was a small group of about 6 or 7 of us. And we drove by Milo, and they put palm trees in the front. They've painted it, they've rebranded it. I mean, they've gone crazy on it. They've put, I would say 5, 6, 7 million easily. And then Dahlia, same thing. They built an entirely new clubhouse. And they're doing like very a higher end renovation than we're doing at both of those properties. So we have good neighbors that are putting the capital into it. So we're not going to be a pioneer here. We're just kind of following the crowd and kind of doing what they did already and kind of tweaking it a little bit. And we think making it better, buying it at a lower basis, maybe being a little bit smarter about the way we're allocating our CapEx, rather than just throwing a bunch of money at it for the sake of it. We're looking at getting, a 20 to 25% ROI on our renovations rather than just going and upgrading like crazy.
And someone was asking, what's the class of property and the location class? And you can see the property is a B- and the location is a B. And with all the other properties getting renovated, then the location elevates. And so you've heard that in the single family home market, that you don't want to buy the best house on the block. You want to buy the worst house on the block. And then as everyone else has the nicer houses, your property appreciates with those. And so it's similar, buying a B- property in a B neighborhood.
Yeah, look at that income to qualification ratio. It's a 3.82, meaning like this property has about $2,000 of delinquency every month. So she's collecting pretty much from every single resident, except maybe 1 or 2 residents every month, which is phenomenal. And it just kind of goes to show you that, these people have been living in this community for 4 years. They like the community. The rents are so cheap, $963. I mean, you cannot be in this location really anywhere else, this central of a location for under $1,000. And so with our upgrades at $1,200, it's still a fantastic deal. So we just think, guys, it's going to get oversubscribed. And so if you have interest in the deal, reach out to Sarah or sign up and register as soon as you can. We're closing in about 30 days on the deal.
Yep. All right, so what else do we want to say about this? I think we talked about most of the points. We'll go into more detail on everything in a minute. I want to highlight number 2, so $50 million of potential value creation with the business plan on a $14.5 million purchase. That's a big ratio. So it's not like it's a $50 million deal and we have 15 million of value we're creating. It's almost doubling. So that's always what we love to see for that appreciation metric. And then, so this number 3, we talked about it already, that next door, they're on their upgraded units, they got $460 more per month per unit. And we're planning to do only about 240 as far as the increase in rent. And that's over the next few years. So it's really telling that, like, bam, they were able to get it right away. We're only trying to get halfway there over the next few years. So that's one of the conservative elements of the underwriting that Shakti opened with. And then number 5, so when we were in Dallas and we were talking to the commercial lenders and the commercial brokers, everyone said cap rates are definitely compressing in the future. So in our underwriting, when you see the equity multiples, we assumed an exit cap rate. Someone said, what does it mean exit? Exit selling. So we assumed, hey, when we're selling, it's a 6.7% cap rate. But what if it's a 5? The numbers are going to be even better. And the experts out there who this is their job to predict that sort of thing are predicting that cap rates will compress. So if they do, then the numbers that you see will be even better, even sweeter. All right, photos. Let's see, I'm gonna scan through the photos quickly, but they're really colorful, really fun. And all right, let's jump into the projected returns, and then we'll get into the business plan. So there's class A, B, and C, which those of you who've been with Sugo Capital and Ashland Green for a while, you'll recognize these tiers. So class A is an investment of $1 million or more. And we'll break it down year by year, the cash on cash. It doesn't start off at 7, but the average is around 7 cash on cash for all classes. You can see the IRRs, and you can see the range is a 2. I think it'll be like a 2.2, 2.3 for class A, but let's be conservative and say these numbers. And 21% average annualized return, and the depreciation is the same for everyone, 40 to 50, 45 to 50% pass through. So class B, that's an investment of $250K to $1 million. And so you can see the IRR is a little bit lower, along with equity multiple and average annualized return. And we'll show you why. So there's a preferred return and there's an equity split, and it's just a different equity split. And so that's why there's a little bit lower of returns. And then class C, that's an investment of $50K to $250K. You can see the cash on cash again is the same, but the appreciation that you receive, so basically how you get your preferred return and how you get your split on the profit at exit, is really where there's the difference. Cynthia, if you could put the link in the chat right now, it's fun. It's sugocapital.com/spicy. And so if you guys want to click on that, that's where you would begin a reserve. So if you're already like, oh, this seems kind of like a no-brainer, I'm ready to jump in, you can click on it, sugocapital.com/spicy, and that's where you put in your reserve. And it's just a soft reserve, but it gives you access to the data room where you can see this presentation, you can see the PPM, the subscription paperwork, and really dive in and do, take your time. This presentation will be posted there so you can rewatch and share with your attorney, your CPA, whoever you make decisions with. So I'm going to talk about class B, and then if you guys are going to be class A or class C, you can spend some time looking at the projections, but usually most of our investors are in the class B range. So I'm going to go over what it would look like to be a class B investor in this deal over the 5-year hold. So year 1, that's when you put your money in. So say you put in 250,000. Well, in year 1, cash flow is lower than the subsequent years. That's when the units are getting remodeled. That's when, and we don't just like go in and raise the rents, right? You remodel, you wait till the lease is ending. When renewals happen, that's when you offer offer the increases. So you can see what the cash flow looks like every year, 3%, 4%, 8, 9, 10. So it does increase over time. And then at the exit in year 5, you can see the principal risk return, that 250K, and then the gain on sale. So it's projected, and Shakti will go over the 5-year pro forma in a minute, but it's projected that this investor for 250K, their split of the profit would return $165,000 to them. So that would be their percent of the gain on the sale or the exit. And so if you add it all up, the cash flow, the principal return, the gain on sale, you'll have turned your $250,000 into $505,000. And so if you do the math, you know, that's where we come up to it's a little over a 2x equity multiple, a little over 20, maybe it'll be 21, 22% average annualized return. If you take an average that over the 5 years. So I want to pause there and see if there's any questions on this slide. I want to make sure people understand the 5-year hold, the cash flow, the gains, that sort of thing. All right, so yes, this is for accredited investors only. Thank you for asking that. And then what is the investment required? So for Class B, it's $250,000. For Class A, I'm just going to bop up a slide. It would be, Class A, that would be $1 million or more. This is what your investment would look like. And then if you're in the under 250 mark, let's say 100, usually that's a nice average for Class C is coming in with 100,000. This is what it would look like. And we don't have the preferred return on here, but that'll be on the next slide. I'm looking to the side because I'm looking at the Q&A, my screen, and the chat. That's why my head's going back and forth. How are cash flows distributed? So you can see year 1, for instance, where it says 3%. So that would be starting in Q1 of 2025. You'll get quarterly checks. Not checks, you'll get quarterly ACH. It'll go straight to your bank account. No checks, guys. All right. Oh, okay. So someone's asking that the number investor equity required 10.6 million down at the bottom. So that's the total raise. That's the total amount that we're raising from investors like you guys on this webinar in order to make the purchase. And we'll go over sources and uses as well. Waterfall structure. So this looks really familiar to everyone who's been with Sugo and Ashland Green. But there's a preferred return of 16% for Class A and Class B. So anyone over 250K will have a 16% preferred return. And what that means is that you'll get an annualized return of 16% per year before there's a profit split to the GPs. So that's before Shakti and Sarah get any percent of the profit at the exit. So that is the closest you can get to a guarantee. There's no guarantees when investing, right? But a preferred return is the closest you can get. So it means that you will get that annualized return before we split the profits between us. So for Class A, $1 million or more, after the 16% return annually goes to Class A investors, then we split the profits 60-40. And for Class B investors, so that's a 250K to $1 million investment, you also get that 16% preferred return. But the profit split after your 16% annualized is a 50-50 split of profits. So that's why your annualized returns will be a little bit lower than the Class A. And then Class C, there's still a 12% preferred return. And I don't think you'll see that anywhere else in the market right now. It's really exceptional. And then there's a 50-50 split of the profits after that. Some people are asking about profits, distributions, and K1s. We will put some examples in the data room. So if you guys go to sugocapital.com/spicy, put in your soft reserve, then you get access to the data room, and we'll put some sample K1s in there. So you can see exactly what box the returns will come in for when you get your quarterly distributions. Shakti, anything else you want to say about the waterfall or the returns before we go to the business plan?
No, they are very very generous waterfall to make sure you guys get paid and we do our
Yeah,
job. And then when you guys get paid, we get paid. So it's a it's a good thing
yeah.
for you guys. Yes.
So for those of you who love to comb through numbers, yes, yes, Barry, we'll talk about the financing. There will be debt. So you will have to consider UBTI if you're investing with your self-directed IRA. This has a lot of, there's a range. So when you're investing, you want to know, okay, we made some assumptions, but what if it's better? What if it's worse? Because we don't know the future. In 5 years, a lot of things can happen, right? So on this chart, you can spend some time on your own, really looking at the downside and upside of, based on if vacancy changes and all these exit cap rate changes. But I really love to point out the break-even occupancy. And so that's that number is on the left in the middle, that 69.3%. So that 70% means that we only need to have the property 70% occupied in order to still, pay all the expenses and the debt and all that. So that's a really nice number. Shakti, what are you seeing in your portfolio as far as occupancy in the Dallas, greater Dallas area?
So we're probably in the high 80s right now.
Mhm.
And that's simply because we are qualifying the heck out of prospective tenants. There's so much identity fraud, pay stub fraud. And so about a year ago, we started putting in ID verification and AI. And
Mhm.
so it's really hard to get to rent an apartment for better or for worse at our communities. And we run at a pretty low delinquency rate. So we're just focused on quality occupancy. So this property already has it because of the low rents.
Yeah.
But yeah, I mean, we're kind of in the 89% range right now, trending to about 91. But we've really had to kind of tighten up quite a bit over the last year in terms of our qualification process. And it's working because our delinquencies are so low.
And when we were doing the property tour with the current property manager, was she saying it was 94% was the current occupancy?
Yeah, I don't think she's ever been below like 88 or 89
Yeah.
and stays in the low to mid 90s.
Yeah. So I'd have to get pretty far away and out of hand before there were any problems financially. That's the gist of it. All right, so this is an eyesore. But I want you guys to, Shakti will talk about the business plan and the pro forma, but feel free to take a look in the portal and go through these numbers. Shakti, you want to take this one?
Yeah, sure. I mean, it's just basically showing you guys the way we're planning on generating kind of that 2x return on your money.
Mhm.
And this is kind of like a snapshot of the alpha return, meaning like, what are we doing as Ashland Green and Sugo Capital other than just buying this thing at a right time, right? So we're putting in $5 million of CapEx, and what's that getting us? It's getting us 192 units. That is going to cost us about 12,000 each unit with a 25% ROI. So you can see kind of in that top left box, we're increasing the rents on those units by about $232. So you're seeing a pretty large bump at the end of year two in terms of our renovation premiums. And then if you look kind of down, I guess, further on the left-hand side, you can see what our property tax assumption is. We use a third-party property tax consultant, and they've given us about a 90% reassessment rate. They think they can get it lower. This is in Dallas County, which tends to be a bit less aggressive than Tarrant County. So they've actually told us they think they can get it to 85 or 80% of 14.5 million in terms of our assessed value. But we're being conservative here and using 90%. And then we've also talked to our third-party insurance broker, and we have a master insurance policy across our 6,000 units here in Dallas. And so this will go under our umbrella insurance, and we'll be able to get insurance at around $800 per unit per year. And then you can just see some of the other income drivers, 20 patio extensions, which are going to cost us around $3,500 each to do. We'll get a 26% ROI on those units. And that'll give us an additional $75 a month. Bulk Wi-Fi cable will give us an additional $43 of income per month. And then we're going to be introducing a community amenity fee, pest control fee, and also increase the valet trash fees. So you can see kind of in the bottom right-hand corner that if we take our NOI in year 5, and then cap it at 6.75%, we get our exit valuation. And then we use that exit valuation when we kind of run through the waterfall. First, we pay off that 10.875 million to Freddie Mac, and then we pay you guys all of your either your 12% return or your 16% return, pay you back all your principal, and then whatever's left over, we split according to that sharing ratios, depending on if you're an A. If you're an A, you guys take 60% of what's left over, we take 40. And if you're in a B or a C, it's a 50-50 split. So that's kind of how the alpha value creation works, just from like a P&L perspective over 5 years.
Thanks for that, Shakti. We have a question from Brian. He was looking at repairs and maintenance in year 1 at 67,000. He said that seems low. He calculated 350 per unit for repairs and maintenance. And he's wondering how that compares to your other properties in the area.
Yeah, it's a good question. So we're actually capitalizing quite a bit of it. If you want to flip to the CapEx budget, Sarah, you can kind of see what we're putting in as part of the.
Oh gosh, where is it?
It's like must be all the way to the back where the business plan is, which is probably a good thing that we get there.
Okay.
We can go back to those slides, but I just want to answer Brian.
Yeah. Okay, here it is. Is it in here? This one.
Yeah, it's next. I think it's a couple. Yeah, so you can see on the left-hand side, Brian, one of the things that we do right out of the box is clean up all our kind of historical issues at the property. So a lot of these typically would fall under a repair and maintenance line item: carpentry, roofs, foundations, drainage, stair towers, fencing, gate, lighting, camera, paint, parking lot. So you can see a lot of these repairs, dumpster repairs. A lot of this is not just beautifying the property, it's also life and safety and R&M. So we're going to be capitalizing that in the earlier part of the term, and therefore once we replace it, we should be able to get through our hold period at a lower R&M cost.
Awesome, thanks. All right, I'm going to go back to here. Actually, I'm going to go back to the debt.
Yeah.
I think that's really important. A lot of people were asking about debt, and then we'll go back to continue with the business plan. You're welcome, Brian.
You and I, we were on the phone the day I locked this. I don't know if you remember.
I do. We were on the phone, you guys, and he was like, hold on. I'm going to go lock in a loan.
You're probably happy because we locked it in when the 5-year was 3.66%. It subsequently went down to about 3.5. And if I locked then, I could have been a 4.8% interest rate. But I kind of put this internal threshold on, Sarah. I said, if I ever see a 3.66 5-year treasury, I'm going to lock. It went to 3.66. I locked. I regretted it for about 2 weeks. And today the 5-year treasury is at 3.91. So meaning this could have been a 5.25 interest rate just as easily. So you can never win with these things. You just have to kind of set a floor, and you have to execute when you see that number. And that's what we did. But I didn't mean to steal your thunder on the overall debt picture.
No, that was great. That's exactly it. So interest only for 2 years, that fixed interest rate, it's agency. It's, we're not in that phase of, what are rates going to do? Like, this is locked in for this duration of this project. You saw the 5-year pro forma. The loan numbers are what they are. They're not going to change. And so you can feel, safe and like, hey, this is low risk. This is not going to create a risk for the property like we've seen on some other properties. Loan will not be a risk for this property. Yeah, basically all I want to say about that. All right. Going back to, and you guys see we're skipping through a lot of stuff.
Go
Yeah.
quick to that refinance, because there's some
Yeah.
there's finance people on this call, and
Right.
they ask us about, how are you so exact and what happens. So
Yep.
what we can do, guys, the way this deal currently models is that we can exit, or we can do a supplemental loan if we would want to after 3 years and pull out $1.7 million. If we use our net operating income at the end of year 3, you get to a refinance value about 29.6 million. And then if you say we can get about 75% of that in terms of debt, or a 1.35% debt service coverage ratio, we should be able to refinance this property and pull out about 1.7 million of cash. So it's an option for us. What we like to do pretty much after we finish the business plan at the end of year 3 is we like to look at and see what does it look like around, I don't know, maybe month 30. Really after 2 years, we start looking seriously at it. We're always looking at potentially selling or potentially refinancing, but we want to usually do that when the business plan is complete, which in this case will be kind of in the middle of 2026. We'll be fully stabilized, and we'll probably look to be frank with you, we'll go back to the brokers that sold us this property and say, can you give us a BOV, a broker of opinion of value? We'll probably go to 2 more brokers, and we'll also go to our debt guys and say, hey, can you give me a refinance quote for this deal? And we'll go to the investment sales guys and say, can you tell me what this would sell for? And then we'll take those 2 numbers, and then we'll run them through our models, and we'll basically look at which is best for our investors. Is it better to sell right now, have a capital event, or is it better to refinance, give 1.6 million bucks or 1.7 million bucks to our investors, and then continue in 2 years and then even sell it for more? So just because we underwrite to 5 years doesn't mean we hold it for 5 years. Our average hold time is about 36 months. And we want to cycle out of these properties and return capital and get you guys into the next project where we can do the same thing, a big value add. So there's a lot of different options on the capital side, on the capital structuring side, to what we can do. But the reason we put this slide in there is to show you guys that based on our base case modeling, if for whatever reason the market isn't a good time to sell in 3 years, we can always do a supplemental, distribute cash, hold for another 2, and then sell. So there's definitely, some many exit doors along the way.
Yeah, I love it. There's so much flexibility with this. I see some people saying they have to jump at the top of the hour. So what we're going to do, guys, is we're going to skip to the slides that talk about next steps and the timeline for this. And then we'll return to where we left off when Shakti was talking about the business plan. All right, so sorry for all the flipping through. It's a big deck. All right, so there's all kinds of comps and market data. So you can see where the numbers are coming from when there's the estimates for the rent increases, the sales price. So next steps. So Ashland Green and Sugo Capital, you can see some stats about what we've been doing over the last 5, 6, 7 years. These are our stats combined together. And so we're co-GPs on this project, and it's the 8th project we've done together now. And so the timeline, what does it look like? So they got the project under contract in August, all the physical due diligence, lease file audits, all of that, all the due diligence is complete. The data room is open now. And so again, if you go to sugocapital.com/spicy, that's how you put in your reserve and you get access to the data room, and you'll get an email reiterating these dates. But we're looking to have this fully funded by October 31st. But we're estimating it'll be much faster because the reserves that I have already seen in there, most of them are Class B. So it's the $250,000 to $1 million range, similar to what you said, Shakti, where you send it out to a bunch of people, and the people who are the investors who know us and who know what to look for, they're like, oh, this one's good. Reserves already in there. We already have a bunch of people signing docs. And so we're looking to take over the property in November 15th. And then first distributions are targeted to begin Q1 of 2025. So that's always an FAQ, right? So when do distributions start? So even though they're not going to be huge distributions in the first year, they will start Q1 of 2025. And then Shakti talked about this every month. The financials will be uploaded into your portal, your Juniper Square investor portal, your personal portal. Every quarter, you get the distributions via ACH. And then also there's the webinar really talking about more in depth beyond the financials, what's going on with the portfolio. And almost, I would say this is true for almost every property I've invested with Ashland Green, that the K1s are delivered early in the year. So a lot of us have the experience of K1s that are delivered like September 3rd, and we're like pulling out our hair. I've never had that happen with Ashland Green, so it's nice to throw that up on there. You do need to be an accredited investor, so we'll send you a link to fill out some data online, and you'll get an electronic version of an accredited investor letter. It's also sent to us, so it's very easy. If you're not an accredited investor, you won't be able to participate in this deal, unfortunately. So how do you get started? Again, sugocapital.com, spicy, and it'll bring you to the soft reserve form. You get an email from hello@sugocapital.com. And you can ask any questions to that email on our website. There's the phone number for investor relations. And then if you have questions, we're having a Q&A session tomorrow. So you're going to get access to the data room. You can review the PPM. You can review the recording of this. You can review the deck at your leisure. And then if you have questions tomorrow at noon Pacific, we're having an open investor Q&A session. I say me. If you go to sugocapital.com, book a call. That's how you register for the Q&A session. That's tomorrow. And we'll have a couple additional ones over the month as well, so that if you have questions that come up after this webinar, you can speak face-to-face with me and ask about them. And then again, we're looking to wire funds by October 31st and take over on the 15th. Now, you see a little picture in the corner. That's Zyra. So when I was there a couple of weeks ago, I'd met her before, but we talk on the phone so much, and I text with her almost every day. And so I thought, hey, I know what she looks like, but maybe you guys would like to know what she looks like as well. Because when it comes time to wire, you'll have the wire instructions. It's in a PDF that we send to you securely through the portal. And on there, it says, please call this phone number in order to verify the wire instruction. There is so much fraud, you guys. So I really encourage you to take the extra 2 minutes to call. Zyra will be the other one on the end of the phone. She'll pick it up and she'll verify the wire instructions for you. So just wanted you to see who would be picking up the phone when you're calling to get your wire instructions verified. All right, cool. So it's 1:03. I wanted to make sure everyone kind of knew next steps, and then we'll jump back and finish talking about the business plan. So if you have to jump, know that when you come and listen to the recording, go 1 hour in, and then you can pick up where you left off. Does that sound good, Shakti?
Mm-hmm. Absolutely.
Okay. All right. Boop, 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 boop. All right, business plan, value add. Take it away.
All right. So we basically look at the business plan into 4 distinct buckets. It's the first bucket is all of our deferred maintenance, the curb appeal items. So a lot of that stuff you guys saw on the exterior CapEx, all the life and safety items, repairing the balconies, the foundations, the roofs, etc. We like to get that taken care of right up front. Also exterior paint. So property starts looking better right away under new ownership. And then in this case, we're going to be resurfacing the soccer field that's there. We're going to be doing a leasing office refresh, updating some of the pool furniture, adding pergolas and grills out there, and then also enhancing the playground area. And then about 3 months in, we'll start our platinum renovation program. That'll take about 3 to 6 months to do all 192 units, because we do up to about 3 units per day occupied. So we'll be able to finish those by month 6. And then we'll start rolling in the other income drivers. So all in all, it takes us about a year, give or take, to finish the business plan, and then probably another 6 to 12 months behind that to stabilize the asset completely, and start looking at exits or refinances. We're increasing rents on this $4.84 million spend. We're taking rents from $952 to $1,197, so about $244 per unit per month.
Yeah, and I highlighted it in red to say, to bring it back to the fact that it's only increasing it about halfway to where compared to the other properties in the area who have done rent increases. Talked about CapEx.
Yeah, so you can kind of see here what the exterior renovation or the interior renovation program looks like in terms of the sequencing. So we'll get to 48 units in January, another 48 February, and then we'll be wrapped up around April of next year. And you can kind of see how that results in terms of increase in income to the property. So around $535,000 of additional potential income at a 6.75 cap rate gets us to almost $8 million of value creation. So in one of those earlier slides, we said there was about $15 million of value being created. You can see more than half of that value is just through this interior upgrade program, which has been proven out by the neighbors already. And then here's a good summary that you can see kind of like where the rest of the dollars are coming from in terms of that 15 million dollars. So the interior program is bringing about $539,000 annually. The patio extensions, $18,000, increasing or introducing the pest control fees, community amenity fees, valet trash, bulk Wi-Fi cable, and also the water savings. Gets additional NOI each year of about $934,000. And you can kind of see if you cap that at 6.75, it's almost $14 million in total value creation just from these initiatives. See some of the rent comps here. So we pulled, 10 rent comps in the submarket. If you want to look at the map, they're on the next page, but all similar properties, 1980s. Like Sarah mentioned, several of these assets, including the Dahlia and Milo apartments, were different phases of Villas del Zocalo. There's actually 4 phases, and the owner still owns 2 of them, has sold 2 of them, is selling us the 3rd one. We're also talking to him about potentially purchasing the last one. But you can see it's in a very tight cluster around Villas del Zocalo, some really good comps, and you can see Love Field, Preston Hollow, University Park, Highland Park, all in the periphery. But if you compare out the rent comps on the next slide, you can kind of see bedroom by bedroom. And I think there was a question about this, is like, hey, how does the property compare relative to other similarly sized floor plans in the submarket? So that's what we do. We look at everything on a floor plan by floor plan basis. So the rents that you guys see in this breakdown are actually our pro forma platinum rents. So our 480 square foot unit is going to cost $1,050. And you can see how that compares to the other similar sized studio apartments. So average in the comp set is about 470 square feet. Ours is 480 square feet, but we're still about $106 less than the comps. And you can see there's some 1960s deals in there, some 1970s deals. And we're actually the newest deal at 1981. So we're a little bit larger and we're a little bit newer than the rest of the submarket. And we're still about $106 less. So that's encouraging. And that's just another sign of where we're being conservative with our underwriting. And then the same thing you can see on the larger 1 bedrooms on the next slide.
The question around a couple of people asked, hey, being close to Love Field, does that affect rents? Is it really noisy? I didn't hear it while I was there, but I may not have noticed.
I mean, we are in the flight path,
Yeah.
but so is Highland Park, believe it or not. So is my house. I was out in the backyard yesterday throwing the football with my son, and I probably saw 6 airplanes fly over. Now they fly closer, much closer to this property because we're so close to where the flights land. I'm about 2 miles away from where the flights land, and yeah, you can see the airplanes and you can hear them. But for the residents, it's not changing what is most important to them, which is affordability, proximity to employers, and then obviously community. So it's not necessarily something that this demographic at $1,000 or $1,200 per month they're not going to eliminate that. And obviously everything in the submarket has that dynamic to it as well. So when we're comping these properties, we're comping to other properties that are also in the flight path. So not an issue at all for this demographic. But you can see on the medium ones, 1 bedrooms, we got about $75 a room here. And then on the large ones, we got 107. So just being really conservative. Sarah flagged it. She put it in red. We do have room for growth, not only with rents, but also we have room on our cap rate, on our exit cap rate, to go down pretty significantly, because our current assumption is a 6.75 exit cap rate, which by any measure is extremely, extremely conservative. Yeah, it's a good question for Jeff. He's just asking if we plan to not raise the rents to comps. In our projections, we want to leave a little bit of room in case we do decide to be not only like one of the better looking properties on the block, but also kind of the low cost option too. So in our assumptions, we think it's safer to assume that the comps stay a little bit higher than us. We typically don't like to make the market. We typically like to follow what other people have already done. And so, yes, that gives us a little bit of buffer for us, which obviously for you guys as investors on the other side would benefit only if our rents went up from where they currently are being projected. So we're basically, kind of just giving a more conservative projection with the hopes to outperform that projection. And then you can see we're $76 below the comps here for the 2 beds.
And I want to point out, because when I first saw this, I misread this and I thought, well, that's not that much different. Because I was thinking it was today's rent is 75 below market, but no, this is saying once all the renovations are done, so there's plenty of room to increase and get up here, but once all the renovations are done, and so that might not even be until year 2 or 3 when everything is at max occupancy and all of that, it's comparing rents at that point in time to the current rents today. So that's another conservative point in the underwriting, is like we're looking at market rent today. Everyone we talked to when we were in Dallas was saying rents are projected to go up over the next couple of years, but we're saying, hey, we're gonna compare our rent in a couple of years to after all of our renovations to rent today, and it'll still be less than rent today before the market rents go up. I want to point that out. Guys, feel free to put your questions to everyone, because there's a lot of the same questions when you do hosts and panelists. It's great for everyone to see what other investors are asking. It helps people get to know the deal and the process for doing due diligence on deals. And so I'll point out, somebody's saying, oh, do tenants get nickel and dime about with fees? Is it a bad area? Will people want to stay here? And I'll bring it back. We mentioned the stat, Scott and Jerome, right at the very beginning of the webinar, but the average tenure for residents is almost 4 years. And so people are sticking around. It's a really sticky property. And so they're not like, oh, this is too noisy. There's too much crime. We don't like these fees. I'm leaving. They're staying. And the community aspect is really, really strong at this property. All right. Sales comps, you want to hit on this real quick, Shakti?
Sure. So a couple other recent trades in the area. Okay, so you can see where our basis is at 75 a door, whereas the comps traded around 90 a door. So we're buying it about $15,000 per unit below the comp set.
Barry's also asking, hey, but don't you think occupancy will go down if you raise the rents up to market rate? And so that was part of the reason we're not bringing it up to what everyone else is charging. We're still going to stay below market rate in order to keep that occupancy high. It may affect it a bit, but there'll be maybe some adjustments, but we'll still be below other, $100 below other competitors. So, all right. So now we're back to the accredited investor steps. Oh, that was perfect timing, Timothy. Timothy said, well, can you post the link? Okay, so here's the link, sugocapital.com/spicy. And then we'll jump over and just do Q&A now. But yeah, sugocapital.com/spicy is how you put in your soft reserve. It just helps us know, how many people are interested at what level, and then you'll get access to the data room, this recording, this deck. If you want to go back through anything that you missed, you can share it. A lot of people say, can I share it with people? Yes, you can share this recording with people you make your investment decisions with. And with that, I'll stop sharing and jump to Q&A. Shakti, do you have a hard stop at the 30 minutes after? I just want to make sure.
I think I'm okay for like the next 10 minutes.
Okay. All right, cool. Let's see. This is a great question. Percy's asking, hey, the current property manager is doing a great job. You have your own property management company. Is there an effort to retain them?
Yeah, we would like to retain the entire team, but the current property manager decided to go into a training role where she gets to work remote. So we're in the process of finding a bilingual community manager um, that'll fit in seamlessly with the demographic there.
Awesome. Greg's asking, why is this available at a below market value? Do you mean the purchase price, Greg? Let me know if that's what you're referring to, or if you're talking about rent. Okay, so he's talking about purchase price. So we didn't really hit on that, Shakti. Do you want to, or maybe we did right at the beginning, but for people who came in later, do you want to talk about how you sourced this deal and got it under contract at the
Yeah.
pricing?
So this deal was actually under contract last year for almost 17 million. And then that buyer, for whatever reason, wasn't able to, close on the deal. And so the equity partner on this deal has been in it for 10 years with the current partner, almost 10 years, and is basically forcing the owner to sell, and he doesn't really want to sell. So there's kind of been, 10 years is a long time to hold a property, and the equity probably just wants a return of capital. So it's kind of being a forced sale. They tried last year, were not successful. They had to lower the price to meet the market. And remember, guys, this deal was put under contract several months ago before there was a rate cut, let alone a 50 basis point rate cut. And now we're in a rate cutting cycle. So I'm sure that the seller could go back to the market and get 17 million, 16 and a half, 17 million for it now. But that's the reason they're selling, and that's the reason we're getting this deal. We think there's going to be other deals in the future. We just have not heard of, we just have never had a 6.6 cap, even in the run up to 2019, even investing in 2017 here in Dallas. The highest cap rate I've ever had is a 5.5, 5.6. I've never had a 6.6.
Yeah, it's awesome.
Yeah. And as complicated as real estate is, guys, it's actually pretty simple. You buy at a high cap rate, you put fixed rate debt, you operate it well, you wait for cap rates to go down, you wait for rents to go up. And you just get the debt right. And that way, if it's 2 years, if it's 4 years, you've got plenty of time. So, but we're going into a rate cutting cycle, and we think in 2026 through 2028, 29, those are going to be amazing years to liquidate our investments and really return a bunch of capital. And, Sarah and I have been talking about some exciting beneficial tax strategies. I know that's probably another webinar we're going to do next year, Sarah.
Yep.
Some of the conversations we've been having about some of those exits that are coming up in 26 through 29. Our investors are going to have to think through the taxes on that. And I think we're going to do some good work, I think, in the next 3 to 6 months, setting that up for our investors.
And on that note, Andy's asking, hey, can we 1031 exchange altogether after the deal exits? So that's something that we are figuring out a structure that will allow us to do that. So the plan is yes. It's not guaranteed, Andy, but the plan is yes, that we're figuring out a 1031 exchange, because it could be likely that the kind of the lazy 1031 exchange a lot of us do, where we exit a property, we go into the next property, we use the cost seg accelerated depreciation to offset the capital gains tax. That's going away, it's getting phased out. So then 1031 exchange becomes more attractive. And so we definitely are looking at some structures that would allow us to allow investors to 1031 exchange from one syndication or one apartment complex into another. Someone's asking, hey, can you 10x the deals instead of 3x them? We will do our best. We will do our best.
It would be in our interest to do that for sure.
Oh, it would be definitely in our interest. Yes. On average, what is the vacancy rate of properties? Shakti let us know it was about mid-80s, the average vacancy rate of their portfolio in DFW.
Yeah, we're about, I'd say high 80s. So we're about 89 right now, trending to low 90s.
Okay. A question about non-accredited investors. Unfortunately, no, you will not be able to participate in this particular deal. Why did Ashland Green sell their properties, the 1,200 units that you've already exited? So it was the right time, I assume, but go ahead, Shakti, you take that.
Yeah, it was a good time to sell in 21 and 2022. So took advantage of it.
There you go. All right. This is a great one. So for class A, B, and C, the question is, are class A's paid first, then class B, then class C? And I believe the answer is no, that everyone is paid their preferred return at the same time. And the waterfall is to A, B, and C at the same time, and then to the GP split last.
Correct.
Correct. All right. Ooh, good question, David. Have you had to make any capital calls in your history? And yeah, so Sugo Capital did a capital call on 2 of their properties. And then what about you, Shakti?
Yeah, so we actually did a capital call earlier this year. And it wasn't actually all negative. It was actually because we have a tax abatement that we're actually, we just got approved for today on most of our portfolio. And those tax abatement costs money. But we called capital on several of our deals. And actually some of our deals are actually going to perform better as a result of the capital call and the tax abatement. Better than originally forecasted. We have a deal that was supposed to do a 1.95x and it's looking like it's going to be a 2.5x. And it's our biggest deal. It's a $250 million deal that we bought as Blackstone with the senior lender, and with the tax abatement, the projections go up to about a 2.5x.
Charles is asking, join late, how many properties do you own? So Ashland Green has 22. We've acquired close to 30. Sugo Capital, we have 30. We acquired 36. Do I need to get accredited again? Yes, and we'll send you a link so you can do it online if you don't want to get a letter from your CPA. Not a problem. No cost to you. Questions about estimate of UBIT. Let me get back to you. Send me an email. You show up as anonymous attendee, so I'm not sure who you are. But the people who are asking about UBIT, if you want to shoot an email to hello@sugocapital.com, I can dig into that and find a better answer for you. But it is 75% leveraged, so UBIT for your self-directed IRA when you invest is a consideration. I saw a question at another point in time. You can invest with a 1031 exchange if you have probably 750 or $1 million more of a 1031 exchange. Shoot me an email. You can join as a TIC member for this deal. You can invest with your self-directed IRA, with your solo 401k, with your trust, with your LLC, with your C Corp, pretty much any structure. It's all open, or in your name, whatever you would like. Is October 31st a hard deadline? Will the investment continue if it's not fully funded? Yes, it will continue if it's not fully funded. I think it will be, but if it's not, it'll keep going until we raise all the money. All right. So Timothy's asking, this is a good one for you, Shakti, before you jump. Maybe this can be your last one. I think I can get the others. Has your underwriting changed to avoid future capital calls?
Yeah, it's a good question, Tim. Actually, on this deal, we don't currently have the tax abatement in there. But, if we raised another 500, 600,000, we could probably do it. So maybe it's something I'll talk with Sarah about offline and figure out. But really, the underwriting basically is more to do, it's less to do with operations, more to do with bridge loans, specifically the cost of rate caps. So we were able to be smart and creative and get these tax abatements in lieu of the rising cost of the bridge debt. So this deal doesn't have any bridge debt on it. So that's the easiest way to avoid any capital calls in the future. But one of the things we do want to consider is potentially a tax abatement on this deal. But it's not in our current underwriting.
Cool. All right, Shakti, if you need to jump, I'm glancing at the rest of the questions and I think I got them. If you need to jump, do you want to give one last, like, what is your absolute favorite thing about this deal? Why don't you leave us with that? And I'll
Um,
stay on, guys.
I'm just gonna speak to all the nerds, I guess, on the finance guys and gals on the call. I mean, real estate is just about it's just numbers, right? And what you do is you just look at where your entry cap rate is, you look at what the cost of your debt is, you look at your exit assumption, and you look at what the potential upside is. And this deal has just a ton of, I mean, they call it positive leverage, the cost of borrowing versus the cost of entry. And so it's a 6.6 cap, and you're borrowing at a 4.9%, 4.95% interest rate. So you have, you know, almost 165 basis points of positive leverage. We were talking to a broker when Sarah was in town, and he was trying to get us to go out to Tulsa, Oklahoma. And he said,
Yeah.
I have a deal with 200 basis points of positive leverage. And I'm like, great, but I have to go to Tulsa. I said, I can get 165 positive leverage here in the number one market in the country to invest in multifamily. And they said, well, and they didn't really have a response for me. So I don't know, guys, when we're going to get these types of deals. We always have deals. We're going to have deals. This will be our last one this year. So if you want depreciation and you're investing with cash, certainly get into this deal. We're going to have deals next year. But what the problem with it is when I bring you a deal next year and you learned everything from this deal, you're going to look at that next deal and I don't know if I'm going to be able to bring you a 6.6 cap rate. And so I would way rather bring you a 6.6 cap rate at 495 debt than a 5% cap rate at, 395 debt. I'd rather sort of buy at a high cap rate, and then we can always refinance later if the cost of debt goes down. So you can't replace the basis. We're buying it at 75,000. 75,000 a door. Chris says, bring us a 7.3% deal next year. Maybe not in Dallas. Maybe if we go to like Tyler or, West Texas or something like that, maybe we can bring you a 7.3. Or maybe if we go to the Midwest, but there won't be any appreciation on that 7.3 cap. It'll be a nice cash flowing deal, steady Eddie, but we won't sell it for much more than what we buy it for. And that's what you get when you buy in Dallas. You get this huge back end appreciation. So it's really hard to find deals that cash flow this high during the life of the hold and then still have this. Somebody is in Tyler. So Nana, maybe we'll come visit you in Tyler and you can help us get a 7.3% cap rate. So this deal has a lot of really great merits, but as a numbers person, this is a deal where the numbers just really, really jump out at you. And the story just feels really good with the basis. So I'd say I just leave it with that at the numbers.
Yeah, they're awesome. I'm so excited about this one. All right, well, thank you, Shakti. Everyone else, I'm going to stay on. But you can't give Shakti a round of applause, but thanks for being here, Shakti. We will, maybe we'll do a Q&A if we get lots of questions, but I think we were pretty thorough. So have a great rest of your day and good luck with the other presentations you have.
Thank you so much. Have a good day.
Yep,
Bye.
you too. All right. Bye, Shakti. All right, everyone. I'm going to take a seat because I've been standing for 90 minutes. But feel free, if you have other questions, I will stick around for another 15 minutes or so and answer any questions that you have. Please explain depreciation rate for this property. Yep, definitely. I saw 2 questions about depreciation. And excuse me, my desk goes up and down. I'm just sitting down and readjusting it. Okay, high depreciation rate for this property. So it's 45 to 50, which I wouldn't say is high. It's kind of average. And so we do a cost segregation analysis on all of the properties. And so there's accelerated depreciation. We bring the depreciation forward into year 1. And so that's how there's a big loss in year 1 that gets passed through to our investors. And it gets passed through to all the LPs. It doesn't get passed through to any of the GPs. And so you guys get to, on a pro rata basis, according to your ownership percent, you get that percent of the pass-through depreciation. Now, some other people were saying, but how can I actually use that? How will it help with 2024 taxes? Greg, I see your question. So in 2 ways. So one, you can use that. So say you invest 100,000, and so you get $50,000 of depreciation on your 2024 K1. If you are not a real estate professional legally, then you can use that to reduce the taxes on your passive income. If you are a real estate professional, as designated by, it's usually a form that you sign off, you meet the criteria according to your CPA. If you do, then you can use that bonus depreciation to lower your AGI, so to reduce your taxes on your active income as well. So I hope that helps. So Jerome, the depreciation can be taken even if you're not a real estate professional, but it can only be used against your passive income. So like say you have 5 other syndications and you got $50,000 of cash flow collectively from your 5 other syndications, and you get $50,000 of depreciation pass through from this, then they would cancel out. So it is the same. So next question is around the fee to get accredited investor status. There's no fee. So the fee is covered by the GPs. So we'll give you a link, you guys. If you already have, so I say the 3 ways. If you already have an accredited investor letter that's 90 days recent, during the subscription process, it'll pause and it'll say, all right, it's now time to upload your accredited investor doc. You upload it, you keep going, you're done. If you don't have one, you can either download the one in the data room and you can have your CPA sign it, or we'll give you a link and you can go to Parallel Passport and it'll ask you a bunch of questions. It'll ask you to upload your documents to a secure portal. And when you do that process, then on the back end, there's an attorney or a CPA who reviews it. And then they send you your accredited investor letter and they send it to us. So you don't have to also send it to us. We'll get a copy of it. So those are the 3 ways you can take care of that accredited investor letter. All right, let's see. Scrolling through. Someone's asking, can you use depreciation against W-2 income only if you qualify as a real estate professional or your spouse does? So say, my husband used to work at Google. So he had W-2 income from Google. I'm a real estate professional. So it counts against our total AGI as a couple because we filed jointly. So some people do that. They try to get their spouse to qualify as a real estate professional so that they can use the depreciation against W-2 income of one of the partners. All right, hope that helps. All right, James, good question. So another question about UBIT and what the estimated UBIT impact will be. So everyone who puts in a reserve, actually, let me show this. So I'll show you how I'm going to get the information to you. Okay, let me share my screen. So when you guys click on sugocapital.com/spicy, you get to this. So this is where you put in your reserve. And so this question, how would you like to invest? If you select IRA right here, so these are all the ways, right? 1031 exchange, LLC, trust, personal name, 401k, IRA. If you select IRA, then what I'm going to do is I will send you 2 things. One is an IRA cheat sheet, like how to fill out all the documents with your IRA. And then second, I will circle back with the CPA on that UBIT question, like an estimate for this property, because we know 75% leverage, and there's some other factors, and I don't know it offhand, so I don't want to give you a random estimate. So I'll ask the CPA, and whoever put in a reserve and says they want to invest with their IRA, I will let you know the answer to that. All right. Let's see. When will the K1 be sent out? So K1s from Ashland Green are usually sent out before April 10th. I still say to investors who are in private investments, like something can happen. So don't be surprised / be prepared to do an extension. My CPA just knows automatically every year to do my extension for me. And as you get into alternative investing, I suggest you do the same. Maybe you get all your K1s in time and you can still hit April 15th, but maybe not. And, you know, lots of times they come out in Q2, not with Ashland Green, they come out in Q1. But lots of times with other investments, they come out in Q2. So doing that extension, you know, just allows you some breathing room to not feel too rushed. All right, let's see. Andy, I'm not meaning to avoid your question, but it might have been what Shakti was talking about. You said, please explain the capital call in the context on tax abatement. How would it affect LP returns? If you want to expand on that and put it in an email, I can get Shakti to answer that. Can depreciation offset capital gains? Yes, Ty. Yes. Disclaimer, I'm not a CPA, so take that to your CPA, but that is what I've been doing. You know, every time I exit a property, then I reinvest that year and do a cross seg on the new property, and I use that to offset the capital gains on my first property that I sold. So definitely time. Yeah. All right. Well, with that, I'll say thank you, everyone. It looks like we're at the end of questions. So thanks to everyone who stayed on for the whole time. And I really appreciate how active everyone was. It's a great time to get all your questions answered. If you get access to the data room today, if you put in your reserve, sugocapital.com/spicy, you put in your reserve on this screen, you get access, you review it, you have some questions. Tomorrow we're having a Q&A session at noon Pacific time, because this is going to go really fast. You saw how good the numbers were compared to a lot of the stuff we've been seeing, right? So I think it'll go really fast. I just looked and we already have about 5-6 million in reserves. And so that's about halfway there. So if you want to come to the Q&A tomorrow with any questions you have, you can see the link in the chat, sugocapital.com, book a call. And I'll be there. It's meeting style. So this is webinar style where you can't talk, right? But I can't see your face. The Q&A session tomorrow is meeting style, which means you can come on screen, you can go off mute, and we can talk and have a conversation. So if you have more qualitative questions or anecdotal questions and you want a discussion around some answers, then sugocapital.com/book a call is a great way to come. And usually we have like 20 people there per session. We have multiple sessions. And that way you can also see what other investors are asking. Some investors are repeat investors with Sugo and Ashland Green. And so you can hear the repeat investor questions as part of your due diligence, getting to know Sugo Capital, getting to know Ashland Green. You can, you know, learn more about doing due diligence on the market and the property based on other investor questions. And you might just hear some questions where you're like, wow, I never thought of asking that. I'm so glad I came and listened. So that's the open Q&A. And it's really fun and interactive. So no planned content. You just come and ask all your questions. So hopefully I'll see you guys tomorrow. I'm going to check one more time to see if there's any questions. Andy, I bet I'll see you there. Yes, Jerome. So capital gains. Well, so Jerome's asking, can the pass-through depreciation offset capital gains tax? And it can. Yes, the answer is yes. And talk to your CPA about it. All right. With that, we'll wrap. I'm going to say thanks, everyone. You're welcome, Maggie. You're welcome, everyone. And I'll see you guys tomorrow at the Q&A. All right. Have a good one. Preview that data room. Bye, everyone.